I'd say off the bat, trading is 70% psychology. Yet, whenever you look into trading education, it's purely chart-based and technicals, which leaves so much room on the table for improvement. Today, we're going to change all of that and do a deep dive into your psychology as a trader. And my hope is that by the end of this video, you'll come away with a much deeper understanding of this heavily overlooked but critical element of trading. If you're new here, my name is Owen F. I've been in the markets for 8 years now and have spent tens of thousands of hours mastering the craft of trading. And my goal with this channel is to save you some of those flight hours, sharpen your edge in the markets, and really expedite your journey as a trader as best I can. Right, all that said and done, let's get into it. This one's been a long time in the making, and yeah, looking forward to sharing my thoughts and insights with you all. Part 1, understanding your mental makeup. So to advance in this area, you really have to understand your own psychology and the inner workings of your mind. Most people don't spend time on introspection, but you really need to hone in and put a spotlight on yourself to advance in this area. It's going to be challenging. It's going to be uncomfortable because essentially what you're doing is shining a light on your flaws and weaknesses that very much prefer to stay hidden in the shadows and not looked at. But I guarantee you, if you spend and dedicate good time in this area, you will be shocked by how much improvement you can make in your journey. Learning the technicals and building a system for yourself in terms of a technical approach is just the first stage of trading. And most people think that once they've got to that point that they've done the hard graft. Well, sorry to say, not the case at all. You're really only 10% of the way by the time you get there. And the rest of your journey is about self-mastery, right? It's about mastery of the mind. As soon as you can start really dedicating time in this area, the sooner you'll get to being successful, profitable, and where you want to be with trading. For instance, a common one I see is stress. People get underwater, they enter into positions, maybe entering with a tight stop or a wide stop. The position starts going against them and they start getting stressed out. So they close the position only to see it run after they close in the direction of their trade, and then are left heavily journaling notions of regret, only to do the same thing next time all over again. Or perhaps you let greed take over, refusing to take profit when the market signals it's time to do so, and completely round tripping great entries without taking anything off the table. So really digging in, understanding where you're going wrong in these areas is the baseline foundations for moving forward in this area, and will really set you up with the right framework to work with going forward. Part 2, bias. So now we're really getting into the more subconscious elements of trading. You'll notice as you analyze different traders' approaches and styles in the market that most of them, whether they admit it or not, have predispositions. What I mean by that is they can be inherently bullish or inherently bearish. Really, these biases or predispositions are formed from our first period of profitability in the markets. The first period where we experience any gain or profit in the markets leaves a lasting imprint on us. So for me, this was the glorious bull run of 2017. Walked into crypto late 2016 and essentially straight into one of the most raging bull markets of all time. And as a result, that left a lasting imprint on me. And I do subconsciously tend to favor the long side over the short side. Now, there is also logic baked into that as well, right? It makes more sense over long scale to be a bull over a bear because the markets do trend upwards over the longer passage of time. And as well as that, if you nail a long in the right conditions, then you can make huge multiples, whether that's trading or on the spot side, where you could only short something to zero. But logic aside, we have to really address this, analyze our own psychology, and see where our disposition lies, so that we can then administer and apply the right tools to balance things out in the correct scenarios. And we do this through self-awareness, critical thinking, and a few handy tools that we can use in the markets themselves. So for instance, if I'm thinking about taking a short setup, my psychological tendency is so that I resist the idea more so than a long. So to challenge that predisposition, I just simply inverse the charts on TradingView, also inverse the oscillators and all the tools that I'm working with. But I find it a really useful psychological trick to see whether the trade is truly one that I should be skipping, or whether it's my predisposition that's seeping into my thought process and making me skip a trade purely because of the side of the trade that I'm taking. But that's just me. You may have walked in during an aggressive bear market, done very well on the short side, and that's then left an imprint on you. So you have to really dig through your journals. You may simply be able to just ask yourself the question and be able to answer it through introspection and self-awareness. For me, it was something that cropped up, I believe, 2-3 years into my trading. And although not a massive issue, still one that I needed to address and one that made a big difference in my trading performance. Next, I want to address confirmation bias. So have you ever been in a position and you hear evidence counter to your position, but immediately feel like you should be arguing against it or shying away from it? If so, you've probably been subject to confirmation bias. And it's another dangerous influence we need to address, whether you're someone who experiences this often or rarely so. Okay, so I'm going to give you some examples of how this manifests in trading. Number one, false belief. So you could be ignoring any counter trade signals that crop up against your position. For instance, you may have entered long off the back of a bullish divergence, then a bearish divergence forms, but you simply choose to ignore it. Or, and this is one I see much more often, you can convince yourself that price must reach a level or zone because that's where it's heading in your mind. Again, you're essentially prescribing thought over fact to your trading approach, which, as students of mine know, I advocate heavily against. It's hugely erroneous and detrimental to your performance. Number two, news and or opinion filtering. So what this means is that you'll completely discount / ignore any news or opinions counter to your position or directional bias in the markets. Number three, backtesting pitfalls. So whilst backtesting your strategy, you could cherry pick out examples of where the system you're testing worked, whilst ignoring scenarios where it didn't work, hugely skewing the results of your testing period to favor a preferential outcome. Number four, one I'm sure you're all very conversant with, holding losing positions. Simply convincing oneself that a losing position will turn profitable and you should keep holding on to it despite clear signs of failure and invalidation. Of course, all of these are very dangerous psychological processes that take place. They can cause massive damage on your equity curve, both on the losing side and missing out on value by not taking trades counter to your bias. Sometimes even subscribing so much to your narratives that you revenge trade, add to losing positions, etc. And worst case, catalyze complete blowing out of accounts. Okay, part three, dopamine addiction. I feel like I'm going to go on a bit of a rant in this section, so forgive me if I do, but you really need to uncover and address dopamine addiction. If it's something that you feel like you may be subject to, then you really need to address it first and foremost before doing anything else, because you simply will not grow as a trader or become profitable if you suffer from this. Talking from experience here, I was, hand on my heart, a dopamine addict a few years ago. I was constantly checking my P&L once in position. I was flip-flopping out of trades. I would get a buzz from taking positions or even just sitting down at the trading desk. And this was stuff that I had to really uncover through emotional journaling and taking a deep look into where I was going wrong in my trading, because essentially that dopamine addiction did lead me to really, going down a negative path, blowing out accounts, living a super unhealthy life, checking the charts every 5 minutes, checking the charts throughout the night as well, and realized that I wasn't in the right mindset or balance within my trading and career, and that to grow into the trader that I needed to be, I had to shed this addiction, go cold turkey, really address it, and appreciate that it would take time to do so because it was so heavily embedded into my nature. Move away from dopamine addiction towards the key tenets of profitable trading: discipline and patience, understanding that I was turning up to hit a home run, right? Hit a hugely high R position, get a massive buzz off it, go out and celebrate with my mates, hit the town, have some drinks, and really live in that sort of cycle of feeding that dopamine loop in my brain. And it was constant, right? Every time I went to the toilet, I was scrolling Twitter. I was constantly scanning the lower time frames for setups. As I said earlier, flip-flopping heavily out of positions. And you know, people talk about monk mode in trading as the sort of paragon of the state that you should be achieving as a trader, which I wholeheartedly agree with. The antithesis of monk mode is dopamine and dopamine addiction. So if you feel like this speaks to you, if you feel like you're someone that may have signs of dopamine addiction, you really need to hone into this area. You need to go cold turkey on social media, or at the least heavily curate your feed so you're listening to the right people, and really only follow accounts that you can extract true value from. But then also put parameters in place. Say you'll check Twitter 5 minutes on Tuesday and 5 minutes on a Friday, set a timer to do so. And then after that, you're not checking socials anymore. The same applies for scanning and charting. Carve out set hours for your scanning time and set your alerts. And then from there, don't check the charts at all. Likewise, once in position, if you're someone that constantly checks the P&L, hide it. Also hide your long and short tools into the object tree. That will help massively in this area, but also with over management. And learn to get comfortable living in the gray area. What I mean by this is, as traders, most of us are mavericks by nature. Really learn to get comfortable in the gray area, not living in the extremes. You're not looking for home runs. You're looking to compound thousands of good decisions and thousands of small incremental wins over long scale. And that's really what trading success looks like, right? Being a successful trader is boring, okay? It's not sexy. It's not meant to be. It's slow, steady, incremental gains, which again is of course misaligned completely with dopamine release and dopamine addiction. But it's something that you really have to understand and align yourself with to get to where you want to be in this game. Okay, part 4, emotional and psychological journaling. So you've made it this far in the video. Well done for doing so. We've covered all the difficult bits. Now it's time to address how we can look at all of our flaws, really start reversing things and move in the right direction. So how do we do this? The best way to do so is by emotional and psychological journaling. What this means is you're not journaling the technical aspects or elements of your trade process. Instead, really how you felt during the trade. So how did you feel during entry? How did you feel during management? And how did you feel during exit? Was there stress present? Was there greed present? Perhaps fear? Maybe you skipped taking the trade because you were scared of the outcome. And even in extreme cases, trauma. You know, as I covered earlier, we are all essentially just creatures of conditioning, and both the losses and the wins that we experience in the markets really have a way of crystallizing themselves in our mind and subsequently, of course, affecting our future decisions. So as you go on with your journaling from here on, yes, of course, note down the technical elements of the trade, but really hone in on the emotional side of things. And over time, this will become a gold mine of insights into your psychological tendencies. You'll start to see things crop up more often than not, and you can really start to hone in on these areas. Again, not going to be pretty, not going to be comfortable. You really have to get comfortable being uncomfortable to make improvements. But once you do, and you do shine that spotlight on these tendencies, then both your performance and confidence will grow massively in tandem. Because like I said at the beginning of this video, learning technicals is really 10% of your journey, and the other 90% is mastering the self, mastering the mind, and learning how to pick out your demons, remove them from your process, and subsequently improve your performance as a trader. So the way that I do this is I manually review my journals every month. And within the journaling process, as I said, I heavily note down the emotional side of things, how I'm feeling emotionally. Now, the way that I operate in my trading these days is really very systematic. But regardless, if I do ever feel emotions during the process, then I have to really hone in on that. If you're someone who feels like realistically you're listening to me going, okay, ONF, I'm just not going to do this, hand on my heart, it's not something that I'm probably going to get around to doing, then you can feed those journals, Word documents, whatever it is, as long as it's in digital form, to an AI model such as ChatGPT, and I'm sure they'll create bullet points for you on your main emotional and psychological flaws. Like I said, very much do advocate doing it manually yourself, but if you feel like this is something that you're not going to do realistically, essentially the best approach is the one that you do at the end of the day, so that is an option for you there as well. And if you need to, you can put together a table in your journal. For instance, did you enter the trade fully systematically, or were there emotions at play? If so, what emotions were they and how strong were they? How did you feel whilst holding the position? And of course, what went through your mind when either taking profits or closing the position out as well? From here, you'll start to get pragmatic with things, understand if you're closing trades early due to fear or stress, not letting winners run due to perhaps previous shell shock, or maybe, as I said earlier, hesitating to enter into positions because you're reliving past losses. Part 5, build a personal rulebook. So now that we're getting a bit further into the process of things from a practical standpoint, a personal rulebook is going to help you stay disciplined, act with your rational mind and not your emotional mind, and really put parameters in place to help you work around your flaws. For instance, the most common pitfall is stress, closing positions early when underwater. If you feel like this is something that applies to you, then say to yourself, if you're thinking about pressing the red button and you know through past journal reflections that it's going to do no favors to your P&L or equity curve, then put a rule in place that you have to step away from the desk. Or if you're someone that overmanages positions, then, put a rule in place that you can't check that trade for 24 hours once entering. I can talk about one of these rules for myself. About 6 months ago, I was entering into positions very often on Thursdays and Fridays, only for that position to do sweet through the weekend as a result of the low volatility period. But as a result of this, I was heavily over managing my weekend positions, only to see them play out on the Monday. So I simply put a rule in place that said, okay, cool, been looking at my past trades, can see this cropping up as an issue. I have a set rule that if I enter into a position on the Thursday or Friday, that I have to tick a box that says that I'm not going to check this trade until Monday morning before I take the trade, and have to strictly adhere to that rule, clock off for the weekends, simply turn all the screens off, go and enjoy my life, come back fresh Monday and hopefully see the trade play out from there. I imagine most of the rules that you'll build will be around cortisol, which is the stress hormone. Cortisol is known to heavily impair decision making. So we act irrationally when we have high levels of cortisol in our system. Also, from an evolutionary standpoint, we have a psychological default whereby our minds want to take us out of stressful environments, which of course back in the day as hunter-gatherers was incredibly useful. As a trader, it's a very powerful and damaging process that can take place whereby we sort of get ground out by cortisol decay as we live through the trade's life. For instance, day 1, we could be underwater on the position. Day 2, still underwater on the position, feeling very stressed out. Our cortisol levels start to rise. Day 3 gets to a point where our cortisol levels are so high that we simply just want to be out of the position, to end the suffering that we're going through and take us out of this negative state of affairs, when really what's taking place are emotional processes, the complete opposite of how we should be operating as traders, much more systematic and mechanical. So if you've experienced this before, you know as well as me, it does no favors to your equity curve. And it's really something that you need to start managing and put rules in place to combat this going forward. You should also put practical rules in place as per your state of function. For instance, if you've had a night of extremely rough sleep, if you're heavily burnt out from work, if you're in a negative emotional place from anything that's happening in real life, whether that's relationships with people, put rules in place that before you enter into positions, you have to be emotionally stable and able to make the correct judgment in the markets. And if you're not, then you simply don't take a position. Practical rules could then also apply to risk management and the way that you size into positions. For instance, if you're someone who deliberately and systematically has second and third stabs built into their trading process, that you approach every stab and attempt of that position with the same risk. Because what happens more often than not with these traders is they go gung-ho on the first attempt, full size, get blown out, and second attempt or third attempt then heavily reduce their size because of fear of really racking up serious losses on the day, and they heavily undersize. The trade then normally plays out in their favor, and even with high R on the trade, they haven't even broken even on the trade in its entirety. So yeah, of course, this section is very subjective. So you have to create a bespoke personal rulebook that applies to yourself to effectively combat these areas. Part 6, systematization. So now we've touched on the bare bones of all of this. Introspection, honing in on your weak areas, building rules around them, and acting with your rational, not your emotional mind. And although all of these very much have their merits, I've got to a stage with my trading where I've developed a highly systematic process as a sort of additional layer of security before I enter my positions. It makes me make the right move every step of the way. It takes all the emotion out of my trading and makes it a highly mechanical process. It's called gatekeeping, and I've often referred to it as the framework for profitability. I've given it that title for a reason. That being said, it's very much an additional tool that I use after spending years essentially on my trading psychology, really trying to iron out the creases in that area and dedicating the adequate time to mind and psychology first. So I'll go ahead and link that video up here. Make sure to save it and watch it later. But as I said, very much an additional layer that you build onto your foundations after mastering your psychology. Part 7, mental wellness. I could talk about this area for hours. Essentially, mental wellness is looking after your mind, understanding that your mind is the machine that drives this game, and that we should be spending so much less time on the charts themselves and so much more time dedicated to mental wellness and wellness of the mind. So how can we do that? Number 1, meditation. If you're someone that struggles with meditation, like myself, then you can use guided apps to help you through this process. Essentially, meditation is dedicating time to the well-being of your mind as best as you can. Treat it like a workout for the mind. It's going to help increase your concentration, your level of introspection. It will reduce your brain fog and just make you a much better trader that operates in a higher state of clarity. And again, it really helps your rational mind take precedence over your emotional mind as well. Number 2, trading-based therapy. Now, this may sound niche and straight up odd, but I dug out a therapist for myself that practices CBT, cognitive behavioral therapy, and did sessions with him based on, sure, my real life baggage, past, etc. But then also spent sessions purely dedicated to trading. and saw huge benefits from having someone to talk everything through, but then also someone knowledgeable that can really help put the correct tools in place to combat some of the issues I was facing. And now you may think to yourself, how is this going to work? I'm going to find a therapist. They're going to be super expensive, number one. Number two, they're not going to know anything about trading and it's going to be a useless exercise. So first off, you can find a good therapist for £50 an hour. That's how much mine costs. Second, you'll be surprised at how quickly they can adapt to your situation because, again, the majority of trading is psychology based, and these are people that are experts in psychology, right? So they're dealing with key emotions such as stress, fear, greed, anxiety, PTSD in some cases as well. And you'll be shocked at the carryover and effectiveness of picking this up. You know, even if it's stuff like denial, low self-esteem, reliving past losses, just spend sessions digging into how you felt and even just getting the words out of your mind. It's like clearing the cache. It's going to do so much goodness for your mind and your mental process and the way that you perceive trading, as well as hopefully lay out some really practical tools that you can use going forward. Next, at the risk of this spilling over too much into a life coaching session, you should all be exercising as well. I weight train or calisthenics 5 times a week. Also do a fasted run every morning as well. You need to treat yourself holistically as a machine, respecting and giving good attention to every part of that machine, mind and body. Physical health leads to calmness, it leads to confidence, and it leads to control. All elements that have great carryovers to trading. Part 8, social media. I imagine I'm going to have a huge drop off in the video at this point because it's probably not what a lot of you want to hear, but the way that you use and interact with social media has a huge impact on your trading psychology. And surprise, surprise, it's not a good impact. You generate very low self-esteem by comparing yourself to others that are essentially posting all of their wins up there, rarely posting their losses, and really piecing together an unrealistic representation of what trading looks like. So you're constantly comparing yourself to an unrealistic other. As well as this, you often follow their thought processes, and anyone that's got to any level of being achieved in this game will tell you that you're only going to make it through independent thinking, and prescribing, or worse, following someone else's thought processes is one of the most detrimental things you can do. This then leads into FOMO, right? You start chasing moves because you feel like you need to catch them. Again, following, the tweet or post of someone else and not adhering to your system that you've toiled over. All of this for what? And I understand it's ironic me saying this on a social media platform, but if you really weigh up the pros and the cons, what's the outcome there? Like me, for years, I convinced myself that I needed to be constantly on social media because I was extracting maximal value from it. Really, that was my dopamine addiction, as we've covered, kicking in, convincing myself of something that wasn't really true. And even when I thought I wasn't letting other people's decision-making processes affect mine, they were, even subconsciously. So I went cold turkey, gave up socials, really went blinkers mode with trading. And surprise, surprise, the result, less stress, more happiness, and better performance. Part 9, framing. Framing is all about our perception of things, and we really need to take active control about our perception of our journey in our day-to-day ongoings. To start, we can view losses as opportunity, not damage, and learn to develop resilience in the face of difficulty through mental hardening, as well as really reining in a voice of self-criticism. Really spend a good bit of time on the framing process in terms of reframing the way you're seeing things when you're trading. I learned through a lot of self-reflection that good things come to you when you start thinking more positively, understanding that there is no real pressure, there is no rush in this game. It will take years, it will take tons of effort, tons of grind, and that we should be really enjoying the journey as much as possible, as well as patting ourselves on the back when we don't take a position throughout the day or even the week. Back to the dopamine conversation, We are programmed and conditioned to think that a win is good and only a win is good. But that, of course, doesn't take into account the days that we don't win or we don't trade. As Charlie Munger and Jesse Livermore famously said, the big money's in the waiting, which is an aphorism that stands true today. But if you're wired to only perceive winning as good, then again, it's heavily misaligned with that notion. So yeah, you'll really benefit from reframing, shifting away from negative thoughts, giving yourself a pat on the back in the right areas, practicing patience, and most importantly, self-kindness. I've been through so much in my journey so far and recently did a video covering all of that in detail. So if you'd like to learn from my experience and see what I had to go through to get to the point I'm at now, then click here and dive in.